quick tip. The Bible says that patience is a virtue, and you better listen.
That's true.
That'll preach, won't it?
Yes, it will.
Hey everybody, welcome to the show. I, of course, am your lovable, adorable, extremely handsome, the most intelligent person you've ever met. Guest host, Jimmy, and this other guy's Tanner.
Nice to meet you.
See, I've already established how this particular episode's going to go. All right, so episode one, we talked about our self-imposed three-legged milking stool platform on which we rest our decision making on investing. Okay, so recap that with me. What were those three rules? Number one
is market tone.
Okay, so just
that's the overall direction of the market.
Is it pessimistic? Is it positive? Okay,
yeah, it's the psychology behind the market.
Okay, and you can just learn that from watching the news.
Right, exactly. Number two is fundamentals.
Okay,
so the fundamentals of the company have to be really good.
All right, so how's the company doing?
They need to be making money.
Right.
Okay. Number three is technical analysis.
All right, now technical analysis, I expanded on that. We released a miniature episode in episode 2. It was only like 6 minutes long that actually kind of delved into that just a little bit and explained why we're currently not in the market because our technical leg was not there.
That's right.
Okay, and so if you haven't watched that episode, please go back and watch that. It's archived under the class section of the website. It's episode 2. So we've already kind of went back into that just a little bit deeper, and we're going to go deeper into that even more because there's a lot to cover.
Yes,
wicks and candles and volume and dojis and shooting stars. Okay, so but we're going to add a fourth rule to our three-legged milking stool, and I think this is important. At least it is for us. And that fourth rule is
God.
Okay, now I don't want to go too deep into this. I know there's some people that just don't believe like we do, and I get that. Well, I don't get that. I sort of understand it. But what we've discovered, at least what I've discovered in my life, is that, God just loves us to pieces. He's always in a good mood, and if we just include Him in everything that we do, everything's more better.
Right.
Now, I know that somebody's going to sit on the other side on YouTube, and they're going to say, well, do you mean that because you believe in God, your investing is just going to always win?
No.
No, but when I do lose, when I do get caught in a situation, when I make a bad decision or life just happens and it goes the way that it goes, I'm going to have a little peace about it at least.
Right.
So, and that's important for me. Tanner and I talked about this, and I said we needed to go ahead and include that. I don't want to shy away from my religion because it absolutely governs what I do in life and should govern, therefore, what I do in investing.
That's right. Every decision.
All right, so last week we also talked about what an option is. So recap that for me. An option is?
It's basically an insurance policy.
Okay.
The insurance policy is something that somebody sells on a stock that they own.
Okay.
For example, there's a type of option out there, or option play, called a covered call. Okay. A covered call would be something where a person would own a stock and then they would sell an option to insure the stock that they're owning.
Okay. We're not getting any.
We're not doing that. But what we are going to do is we're going to be the person on the other end buying that insurance policy.
Okay.
So essentially...
But we're not going to keep it.
No, we're not going to keep it. In fact, we're going to just hold on to it for a short period of time while that underlying stock, while the stock moves in the direction we're wanting it to, and then we're going to sell that insurance policy because
it'll be worth more money.
It'll be worth more money.
Okay. So now something that we I don't know if I mentioned last week, but I want to make sure that we mention when somebody writes this insurance policy, it has a shelf life on it, an expiration date.
That's right.
It's only how long? 6 months?
6 months typically, yes.
Okay. So we don't trade an option early on or late. We trade it in the middle so there's still some time to offload that to somebody else.
That's right.
Okay.
Exactly.
So today we're going to talk about some rules about option, rules that govern how we trade an option, what we're looking for when we're looking for an option. And rule number 1 is, and I keep looking down here, that's because I have made myself some notes. Rule number 1 is mirrored movement to the S&P 500. Now we talked last week that the S&P 500 was our snapshot of the market. What is the market doing and how is it moving? And so if we can find a stock that's moving sort of identical to it, it doesn't have to be exact, right?
Right.
Just close.
Close.
Then we lend strength to our trade.
That's exactly right.
Or minimize risk.
Minimizing risk.
Okay, so I've got a picture here for you because I found me a stock.
Okay.
All right, so I'm gonna pull up this screenshot. This is a charted graph movement of UAL, United Airlines, United and Continental merged here this year. It was a long, hard-fought battle for them, but they were able to do it. So they merged, and ever since then, the movement on their stock has mirrored the movement on the S&P 500, which puts it immediately on my watch list as something for me to pay attention to.
Right.
Okay. Now, another one of these rules is we need to look at volume. So as we're looking at this chart, we can see how much volume is traded in a day. What's our minimum volume that we're looking for a stock?
For a stock, we're looking for at least 300,000 shares a day.
Trading hands.
Trading hands every day, and that's an average. On the charting software, you can always pull up a bullet and see what it opened at, what it closed at, its trading range for the day, and then also an average, a 50-day moving average for volume.
Okay.
And so you're going to go off of that. So we're looking for
And
that.
we're going to get into what that looks like
yeah.
when we start going into the technical stuff.
Right.
Now for an option though, and which is where I want to move because that represents the most profit for me with the least amount of risk. I'm looking at how many trades, not 300,000,
But 500,000 as a minimum.
Okay, why so much more?
The reason why is because just like any other commodity or just like anything else on the shelf, you want there to be demand for what you're possessing, what you're purchasing. So I want there to be a whole lot of people interested in it so that when I get ready to sell it, it's actually worth more, because guess what happens? If there's nobody out there to buy it, even though it went up on paper, it's
worthless to me.
That's exactly right.
All right, so 300,000 if you're just trading stocks, and I know a number of people out there, they don't have the capital resources to invest in options yet. They're building up that seed pile, and I like that analogy. It's a pile of seed, right? And they're not there yet, so they're going to trade stocks, 300,000 for a volume for stocks, 500,000 if you're going to go into options.
That's right.
Next rule is that we look for stocks that only have a 15% movement. Now, why is that?
Well, if a stock is keeping the same price over a long period of time, in other words, going level and staying level, there is no money being made on that no matter what. The only thing that makes money in the stock market is movement. Either movement up, movement down, but sideways movement is worthless. So we're looking for a movement that is in the 15% range. It can be more. It can be less. But the ideal range is a 15% mark. So you're going to want to find a stock that has a 15% movement from the top to a trough, or a peak to a valley, a 15% movement, and in a particular amount of time as well. Or we'll get to the time here in a second. Very good. Yes.
Okay, so let me pull up my screen capture again of UAL, United Airlines. And so here is our peak. It's at $40 roughly. And our valley, our previous valley was at $30. So the difference between that is $10. Now, how do I figure out what the percentage is? I had to Google it.
Oh no.
So to figure out the percentage of movement, if it's a 15% or higher, you simply subtract your peak from your valley. In this case, our peak was $40, our valley was $30. It left me with $10 difference. 10 divided by my higher number, 40, gives me 0.25 or 25%. So this particular stock has a 25% movement. That's right in my target.
That's right.
Okay. So not only is it mirroring the S&P 500, it's got more than 15% movement. It also has the volume of 500,000 trades per day or higher, especially if we're looking at options. Now, we also look for options that are in the middle of their life, and what do you mean by that?
We want it to be at least 3 months out, but no more than 4. So the 3 to 4 month range on the life of an option. Every option has an expiration date, just like the car insurance policy that we were talking about earlier. it has an expiration date, and we're wanting to get in the middle, which means the same amount of time.
Okay. So if
Sorry.
well, no, it
Yes.
makes sense to me because when I go to offload it, I need somebody to be standing in line waiting for
That's
it.
right.
And so if I'm still got plenty of time left before that thing expires,
And somebody's standing there.
right, they can sit there and move with
That's
it.
right. Because just like the insurance policy on the car, once it expires, it's completely worthless.
Okay. All right. Now, here's another important fact, and this is true for stocks and options, is we don't trade in amateur hour. Please tell these people what amateur hour is.
Amateur hour is the first hour of trading. So from the opening bell until the first hour has passed, we call that amateur hour.
It's often chaotic.
It is very chaotic, and a lot of day traders, that's typically when they start their day, and so they'll get into their initial trades, and what we want to wait for is for that hour to expire and then see what the big boys are doing, because remember how we talked in that first episode that we're actually trying to find where the big boys are and where they're going and just simply get right along behind them and let them pull us in the direction they're going.
Okay, that's a good analogy. Well, do any of the big boys, did they ever invest in amateur hour? They don't.
Sure.
They do?
Sure.
Okay.
Yeah, they do. They invest in amateur hour, but it is so hard to determine when it's the big boys and when it's just somebody
Overnight,
else.
all the
That's
overnight trading.
All the overnight trading, because all the overnight trading gets posted right there at the beginning, and so it muddies the water. We don't want to trade when the water's muddy. We want to trade when it's clear.
Okay, so let me define that just a little bit better. Okay. So I get home from work. I drive a truck.
Okay.
I get home from work. The bell has closed. I go sort through my stuff and I look for me a stock that I want to trade into and I find it. Now the market's closed,
Right.
but I can still log on to my trading account
Sure can.
and put in an order to buy or sell.
Uh-huh.
Okay, but it just sits there.
Right.
It sits there till the bell opens in the morning, and that's why we have all this chaos.
That's right.
All those orders get fulfilled
All at once.
all at once. Okay, so that makes sense. So we wait for all of the, like you said, the water to clear,
Right.
and try to get a better picture in hour two or later. Okay, and now when we're looking for something that's in the money. Now, what I mean by that is you log into your trading account and you got to do some sorting, because there's not just one option available for a stock. There's
A bunch.
yeah, tons of them. Okay, and we have to pre-sort
Right.
that into a pile, a short list, if you
Right.
will. Okay, and the first thing that we do is we look for something near the money. Okay, now what do you mean by that?
Near the money means that it is close to the actual price it is selling for right now.
Okay,
So near the money can either be out of the money or in the money, and we're going to disregard out of the money altogether. Out of the money means that the insurance policy is worthless because the event has not occurred. And I say worthless. If it's close to expiration, it's worthless. But it has some value because people think it may happen or it may not happen.
I got you.
What we're going to look at is in the money options. So for example, if a call option is in the money, and let's just throw some numbers out there. Let's say that a stock is $50.
Okay.
And we're going to do a call option. We're actually going to be looking at a call option that's $45 or $47.50. And the reason why is because that option has value already,
Okay.
because I can call somebody up who owns the stock. You can call the person who owns the stock and say, hey, by the way, I want to buy that stock. I know that it's trading for $50 right now, but I own the option to buy it for $45.
Okay, so yeah, you can immediately make a profit.
Oh yeah, you can claim that anytime you want to.
Okay.
You don't have to wait for the insurance policy to get close to expiration. It's immediately available to you.
Okay.
Which is why the value goes up, because it's already an event that has happened.
Okay.
It's as if the car has already been in a crash.
Okay. All right.
Now on the other side, for a put, let's use the same stock, the $50 stock. We're actually looking for $52.50. That's the option we're looking for, or $55. And the reason why is because on a put,
When the stock
we're saying the
devalues,
stock goes down. It's going to go down. So when the stock devalues, the put
makes it worth
more money. Okay, so that's the way that it would work is if I owned a $55 put option on this $50 stock, if it started going down $45, $40, now my put option has become even more valuable. And the reason why it becomes more valuable is because I can say, okay, well, I'm going to be able to get rid of something for my strike price.
Okay, so let's break this into a situation. Make
Okay.
sure I got it.
Uh-huh.
Okay, we've done this once before, but
Sure.
we'll do it again. So let's say we look at that $50 stock, and it does something crazy in overnight trading, and it gaps. It goes to $100 a share. So previously, it was worth $50 a share, and now it's worth 100 bones. Okay, but I owned a call option saying that I did believe that it was going to go. Well, when I went and bought that call option at a $50 share price, I bought it for $45, just below that. Okay, I bought that option for $5 a share, or $5 an option.
Right.
Okay, so now the person that wants to capitalize on that could say, Jimmy, sell me your option that you bought for $5 an option. I'll give you $25 for it. Okay, I just quadrupled my money.
That's right.
Okay, but it's still worth something to him because now he can force that person to sell him that $100 stock for $45.
That's exactly
and he gets
right.
to make all that profit.
That's right.
Got it. All right, clear as mud. And when it's a put option, we're just doing it in reverse order.
That's right.
Okay.
Doing it in reverse.
Okay. Now, what is the? We kind of chased a rabbit there,
Yeah,
but
we
that
did.
was a good one. What is the risk that's associated? If that $5 option can be worth $25, I mean, it just balloons. It grows exponentially large as the stock trickles up. It's exponentially growing at a much faster rate. That also means if it moves in the opposite direction, it could hurt.
That's right.
So that's why following these rules are so important. Okay. All right. So let's see. We covered mirrored movement of the S&P 500.
Right.
We covered the volume required for a stock or option. An option is 500,000 shares traded a day, and a stock is 300,000 trades per day. That's kind of what I'm looking for.
Right.
I'm looking for stocks that have a 15% movement the stock breathes, as you call it, breathes in and out.
Peaks and valleys.
15% are moving or more because that's going to maximize my dollar and give me more cushion for when things begin to turn. Okay. I'm only looking for options in the middle of their shelf life.
Right.
So if it's got a 6-month shelf life, I'm looking for something that's still got 3 or 4 months left on it.
Right.
Okay. I'm only trading after amateur hour is over because they're amateurs. Why do they call it amateur hour? Because a day trader is not an amateur by any stretch of the imagination.
Right. They call it amateur hour just to give it a name.
That sounds mean. Somebody very cruel came up with that.
Somebody.
We're looking for options that are near the money.
That's right.
So on a call option, we'll use the $50 analogy. On a call option, I want at $50 or just below it.
Just below it.
And on a put option, I want at or above it.
That's right.
Okay. So now let's look at my screen capture here of UAL. So we went in and we pre-sorted options for United Airlines using E-option. And of course, you don't have to use E-option. We don't care who you use. That's just who we use because they're affordable.
That's right.
$3 a trade. So I've got some things that I need to point out. The first thing that I need to point out is this last price up here in the top left-hand corner. What the heck is that?
Last price, this one right here, is the stock price.
So is it 37.22 or 37.20? Oh, okay. Okay, I got you. So it's 37.26.
That's right.
That's what the last close was on the option. That's how much it's worth.
Well, actually, that's the value of the stock right there.
37.26.
And when you're starting to look at options, your prices are further down, like your bid and your ask columns. The price of the options are actually located there.
Well, the way E-option works is when we pre-sort it, the ones that are near the money, we've got a video at the website showing how to do this. Already done, watch that video. So I pre-sorted this, and the target range for me is the ones in these gray bars down here.
That's right.
So using that same tutorial video that we already have at the website, that we hope everybody has already watched and practiced with,
Right.
okay? I'm looking, the first thing I need to do is determine the intrinsic value of the option, okay? So I get that right? Okay, so intrinsic value. So I do that by taking the strike price and subtracting it from my last price.
That's correct.
Okay, so I'm looking at, I've already done this a few times, so I'm getting to where I can kind of spot them right off.
Right.
I'm looking at this one for a strike price of $40. The difference in price between the strike price of $40 and the last price of $37.26 is $2.74. $2.74. All right. Now I move over to my bid or my ask. What's the difference between a bid and an ask?
The bid is what you're willing to buy it for.
And the ask is what the market
somebody's
value.
willing to sell it for.
All right. So in this particular case, on that particular option, my bid price is $4.75 for an option, but my ask is only $4.85. Well, I could just do a market order for that.
That's
It
right.
would be easy.
That's right.
And it's
Because
only
well
10%.
within the spread.
Right. Okay.
Right.
So normally we would give them a 20% or 20 cent,
20 cent.
a 20 cent
Right.
cushion. Well, in that case, there's already 10 there, and it's already asking for it. So I'll just do that.
Right.
All right. So I'll take my intrinsic value that I determined to be $2.74, and I'll look at that. I'm going to look at my ask price,
Right.
which is $4.85, and I want my intrinsic value to be roughly as close to 50% of whatever that is.
That's right.
So $4.85 is $2.42.5, 43 cents.
Right.
$2.43. I've already determined that my intrinsic value is $2.74. That's pretty close to that 50% mark.
That's correct.
I'm good to go so far.
Right.
All right. So now what we need to do is we move over to open interest. And this is really important. This can get you hung if you don't
Yes.
understand that. So the open interest on this particular one is 140. What does that mean?
It means that there is 140 individuals out there who are interested in that particular option.
Okay. All right, so one person could actually be buying multiple contracts.
Yes.
One contract is 100 options,
That's correct.
but he could be willing to buy 30, 40, 50, 100 of them.
Or 250 of them, or
1,000
however-
of them, yeah.
Yes.
All right, so one person could be a huge order. We don't know. How do they, just out of my own curiosity, does E-option or any of these trading companies know, how do they know 140 people are actually interested? Are there open orders on these things?
No, it's not the open orders. It's actually the record of ownership. That's how they determine. Yep, because when you place an order on the exchange, your name is attached to it.
Okay.
So it may be a number that represents your name, but they can tell who or how many people are actually interested in a particular item based off of that.
Okay.
So it could be institutions, or it could be people just like you and me. There could be 140 tanners out there who are who are looking at that. But the key number is it needs to be at least 100. If there are 100 open interests, people out there who are interested in that particular option, then when it comes time to sell it, you have at least 100 people who are interested in buying.
So that's important to know, because you're going to find where all these numbers match up, and you're going to see open interest of 3. You probably shouldn't buy that.
No.
You know, I'm not supposed to be giving investment advice. He's giving me investment advice. We don't give you investment advice,
Right.
Because we don't want to get in trouble with the SEC. But if you're buying something with only 3 or 4 people interested, you're probably not going to sell it.
Right.
Okay, which means you're going to have to hold on to that thing forever until it finally expires and you lost all your money.
That's correct.
Okay, and we don't want to lose all our money.
Right.
All right, so open interest of 100 or more, that's one of our next rules. All right, now I'm going to move all the way over to this delta column. What a weird, strange number. The delta on this is 0.591. What does that mean?
A delta is a really complicated number that they came up with.
You don't know
but
either.
Here's what it really represents. I can give you a visual picture of what it means. Think of the wind blowing
Okay.
on a tree.
Okay.
Okay? The wind blows the same on the base of the tree as it does the top of the tree.
Okay.
And when the wind is blowing up against the trunk, even if it's just this big around, the trunk isn't going to move side to side. It may move depending on how strong the wind is.
Right.
But the higher up the tree or the further away from the ground you get, the more that tree is going to sway in the wind.
Okay.
Well, that number represents how far up a tree you're going. So,
Okay.
in a wind, when a stalk is moving, this is how we would say it. When a stalk is moving, the further up that tree you go, the more it's being affected by the movement of the stalk. So, a number 59 would mean you're more than halfway up that tree. And watch a tree sometime in the wind, and you will
Okay.
notice that it moves quite a bit. So we're
So
looking for a
How does that
different
relate
movement.
to profit? I won't talk about money. How does that
talk
relate
about
to me
money.
making money? Yeah.
It means that when the stock moves in the direction that we're anticipating it to move, and you have a call option, for example, if it's going up, it means that that stock is moving, or the value of the option is moving exponentially in comparison to the underlying
Okay.
stock.
All right. So when we said that an option, you can make exponentially more money on the option than you would the stock. For instance, if we look for a stock for the 15% movement, you told me that the option to that could have a 40% movement.
It could.
And the reason why it could be 40% is because we're further up the tree.
That's exactly right.
So the higher that delta is,
Uh-huh.
the more exponential profit I'll make.
Possibly.
Possibly.
Uh-huh.
Okay. Does that also mean if it goes the wrong way, the more loss I could incur?
That's correct.
Okay. I don't want to incur any loss, Tanner.
I know.
All right.
But risk is always paired with reward.
Okay. All right. So that's why we put so many of these stupid rules in place.
Yes. It's to protect us. And now all these rules, they're the ideals. And that's really what we're looking for, because we don't want to take on any additional risk unless we have to.
Okay. So eventually, at some point in time, we're going to talk to these people about a home run scenario
Uh-huh.
where all of these, because everything we're talking about here is a gray area.
Right.
If it's at or close, or if it's just about, or if it's above. But there is a perfect scenario, a perfect storm that everything lines up perfectly,
Yes.
and you hit a home run.
Uh-huh.
And we're going to talk about how to recognize that. All right, you're going to teach me that.
Yes.
You better teach me that. I need to afford health care, y'all. Right now, I can't.
Yeah.
So, God, that's scary. I don't even want to go in. We'll go into a deep, dark political rabbit
Yes.
hole if we go down there. But that is just scary. I don't know how I'm going to pay for it. But this is part of the reason why I'm doing what I'm doing. All right, so let's go through all of these rules. Okay, well, wait a minute. Let me back up one thing.
Okay.
If we're looking for a stock that has a 15% movement or seems to have a predictable pattern in its movement, then I should already know about when I'm going to get out.
That's right. In fact, you want to know when you're going to get out.
Okay.
The reason why is because if it's predictable, if it's repeatable, if it's done it before, it's more than likely going to do it again.
Okay.
And so if you don't know when you're going to get out, then it is not predictable, repeatable. None of those conditions have been met. So you're going to look at when you're going to want to get out of this based on support
Okay,
lines.
now I have another question for you. Though.
Uh-huh.
All right, if I'm supposed to predict where I'm supposed to get out of, all right, and I'm going to calculate that all out,
That's right.
at some point in time, something's going to go the wrong way on me.
Uh-huh.
At what point in time do I sell it like it's on fire? Okay, there's got to be some sort of rolling, okay, Jimmy, it's okay, it's just breathing, just relax, it's going to be calm, and then get out now, dude, get out now,
Uh-huh.
get out now, put it in order now.
Right.
How do I know, how do I determine to do that?
You base that off of all the rules that we just talked about.
Okay.
However, the main ones that you're looking at are your technical analysis. In other words, if we're thinking that a stock is getting ready to go down and we get into a put play because it's on its way down,
Okay.
and it turns around and goes up on extremely high volume,
We're selling it.
we're
like it's
selling
on
it. Yes.
Okay, so I was trying to toss you a softball and you whiffed. Okay. I wanted you to talk about
What's the softball?
rolling stops or stop outs.
Oh, okay.
Okay, so
Yeah.
and it's different for a call option than it is a put option. It's different for a stock than it is an option.
Compare with, yes, that's
Okay,
correct.
so what do we mean by that? So if I jump in it, we'll keep our math simple. It's
Okay.
a $50 a share stock. It's going to go to $100. That's what I'm believing based on its previous trend.
Mm-hmm.
That'll never ever happen. But we're going to pretend like it is. Okay, so I predict that it's going to go to $100.
Uh-huh.
As it's moving up, what I need to put an emergency get out point. What does that need to be?
It's
Is
going
it-
to be at your 8%. 8% below your support line. So your bottom line on your chart, you're going to get in right there or really close to there.
Try to, yeah.
Uh-huh. And you're going to set 8% as your loss. So if it goes the other direction, 8%, you're going to go, okay, I am going to have an expense on this, so I'm going to go ahead and sell it and get out of it.
Okay, so let me change my math up then
Okay.
because I'm not very good at it and I don't feel like pulling out my iPhone here. In fact, my iPhone's over there. So let's do a $10 a share
Okay.
stock. We'll look at a stock, a $10 share stock. So if the stock is $10 and I need to set myself a stop out point, and it needs to be 8% of when I went into it, then I'm looking 8% of $10 is 80 cents, so that's $9.20. So if that stock falls to $9.20, I bail.
That's right.
I don't hold on. I've went as far as I'm going to go. I'm out.
That's right.
Okay. Now it would make sense to me then that if this stock continues to rise, let's say I believe it's going to get out at $15.
Mm-hmm.
I'm just doing stocks. So I'm at work. I'm a mechanic. I go take a pee break. I pull out my iPhone. I check. And I say, "Oh, look, it's $11.20." Do I want to leave it at $9.20, or should I bump it up?
Bump it up. You
Okay.
can do what's called trailing stops, which means you just keep your 8%
Okay.
and you keep moving it up.
Now
follow.
with stocks, I can automatically put those in automation.
exactly right.
So it'll automatically sell out for me.
Uh-huh.
Okay. So if it turns around on me at any time and starts moving back the other direction, when it gets to that automated get out point, it sells for me.
That's right.
Puts it in order. Well, that's awesome.
That is awesome.
But I'm going to have to manually bump that up as it moves up.
Uh-huh.
Okay. So let's say it gets to 1485. Okay. I said it's going to get to 15.
Okay.
But it's at 1485 and there don't seem to be no slowdown. Okay. I'm going to continue to hold it.
Okay.
Would that be wise?
You can continue to hold it if you want to, since you're in.
I mean, if
since
I'm
you're
just
in stocks.
continuing
and
to
just continue holding it, continue bumping your stop limits.
Okay.
Just keep on moving them up, moving them up, moving them up, and you will eventually stop out.
Okay.
You'll eventually sell out.
Okay, so that seems like a really advantageous thing to get in with stocks. Okay, because I don't have to mother it. On options, though, that automation doesn't exist, does it?
No, it doesn't.
So, we're talking about stocks for you guys that work a 9 to 5, 5 days a week, especially if you're in an environment that you don't have the ability to go touch it every day, then the stop loss thing, is it stop loss? Stop out.
Stop loss or stop out is called all kinds of different things depending on what you're trading.
But you could
So-
set your automation point in there, and then periodically
Good
on your
follow.
lunch break or whatever, you check it, and you can just keep bumping it up with it. And eventually, it's going to turn, and when it does, it just automatically sell for you, and you're good to go.
Right.
Okay.
You've secured your profits.
Well, if I'm trading options, if Jimmy's trading options, I can't put in automation.
No.
I'm going to have to physically touch that thing all the dad burn time.
Right.
And this goes to something that you and I discussed in the very beginning. I'm like, well, I need to be in 40 different options because I don't want to put all my eggs in one basket, and I need to diversify. Diversification. I hear that all the time when I'm listening to E-Trade ads.
Right.
So diversify. That's what I got to do, right? And you're like, no.
Nope.
Well, that's why I can't physically touch 12 different options. I'll
right.
blow my brains out. I will lose my mind.
Yeah, we don't want that.
No, we do. My wife especially doesn't want that.
Exactly.
She needs to pay for the health care. So I'm only gonna look at one. If I wind up in a situation where, and I'm in a fortunate situation, I can look at it all day long. Eventually, as I become more comfortable with this, as I have more assets to invest with, I can look at one or two or three
Sure.
options, but I don't want to go crazy with it. And I saw something the other day. Who owns Berkshire Hathaway? Is it Warren Buffett?
Yeah.
He's the god of money. He just owns more money than
He's got a ton.
he's got a ton. Do you know that he's only invested in like 60 stocks? And
Amazing.
And he has a team of people
That's right.
that covers those, and they're only invested in 60. With that much money to invest, you think they would just have the market saturated, but they don't.
Nope.
They're very careful and targeted, and so you can micromanage a few, but you can't micromanage many.
That's right.
So, all right.
Put you into an early grave.
So let's recap this real quick. I want to make sure I got this, and then we're going to talk about next week because
Okay.
we're kind of up in the air on next week. So, rules for trading options, the Jimmy Belt self-imposed rules that Tanner's going to beat him up with if he doesn't do them, are mirrored movement of the S&P 500. We had a great example of UAL because it's doing the exact dead bird thing. I'm looking for, if I'm just trading stocks, I need a 300% volume. I need a 300,000 shares traded in a day average.
That's right.
Okay, but since I want to get into option, I got to up that average to 500,000 just because I want to make sure that I can offload them suckers when it gets time for me to sell.
That's right.
Okay, I'm only looking at stocks that have a 15% movement or higher because as the stock breathes, as it goes up and it goes down, it gives me more opportunity for growth in my option. A 15% movement in the stock could mean 40, 50, 60% on the option. It could be, we've seen a lot higher than that. But anyway, we're being conservative here. I only look at ones that are in the middle of their shelf life because I'm only going to keep it for a week or so, maybe not even a week.
That's
depends. Right. And that gives me the ability to have lots of expiration date left on it and makes it more attractive to somebody wanting to buy it from me.
That's right.
Okay. I'm only going to trade after amateur hour, not because that they're amateurs. That's just because somebody was mean and named it that. But all those overnight trades get
right.
dumped into the market within that first hour, and there's a lot of chaos. And right. we can't predict things and decipher things out of chaos. We
That's
have
right.
to wait for that to settle out. All right, I'm looking at an option that is near the money. So if I'm looking at a $50, let's look at 10. If I'm looking at a $10 option, right, or a $10 share stock, well, we don't invest in those. Maybe that's another rule that we need to put in. We're really only looking for stocks that are valued at $25 or higher because there's less volatility and more interest in the option itself.
And in the stock itself.
And in the stock itself, too. Okay, so let's say I find one for $25. Okay, then I'm looking at an option that is at $25 or just above or below, depending on if it's a put or a call, right?
That's correct.
Okay. I'm looking at, I need to determine the intrinsic value. Now we've already, again, one more time, there's a tutorial video on the website using eOption that shows you how to sort those options out and how to actually purchase one. We walked all the way through the purchase process.
That's
okay?
right.
So that, because it can be confusing, it is confusing the first time.
And you need to watch it several times.
Yes,
just
go
to
practice.
Get your brain wrapped around.
And, in fact, we had a guy by the name of Robert. Robert saw the little video and he went in and he decided to practice and he discovered an error message popped up that says you're not certified for this kind of purchase. And he went, what? Yeah. And so if he hadn't went in and practiced using that video, he'd have never caught it. He was able to contact eOption today, get the necessary additional paperwork filled out, and he got all that straightened out today. So please go practice just to make sure that everything works right.
Right.
But you need to get it in your brain, I think. So I need to find my intrinsic value. My intrinsic value needs to fall into the 50% range,
Of
roughly,
the value.
of the actual price of the option.
That's right.
So if it was a $5 option, I'm looking for an intrinsic value to be at around $2.50 for that.
That's correct.
Okay. I also need to make sure that I have enough open interest. So 100 or more open interest, because the more open interest you have, the more people are actually interested in buying it from you when you get ready to get rid of it. And then I move over to my delta, and I need something that's 0.500 or 50% or higher. The higher it is, if I had something 0.79, that would just be sweet, because it would do a lot of movement on the win side. You're looking at me like I'm stupid, though.
It would be sweet on the winning side,
But
yes.
if it went the other way, it would be doom, gloom, despair, wailing, gnashing of teeth,
All of that.
Okay.
Stay close to the 50%
Yes,
mark.
sir.
As close as you can possibly keep it.
Okay.
Sometimes it's not possible to be dead on, but we're just giving a ballpark.
Okay. All right. All right. I think we covered that. I think I covered everything. Do I need to go over anything else? That's generally it.
That's it.
Okay. So now here's what we're going to do next week. Now, our episode 2 video that we released talked about why we're not currently in the market and gave you a snapshot or an introduction into technicals, how to do some charting. We drew lines and everything like that, and you have not watched that, please go watch that. It's very informative. But it explained why we're not in the market right now, because that three-legged milking stool, one of them legs is missing. Okay,
right.
and that would be the S&P 500 was higher than it was supposed to be.
That's right.
And we're waiting for it to go back down or to establish new trends. Well, today we saw a really good sign. The last couple of days we saw a really good sign. It's trending downward, and it finally passed through our top line, our previous line of resistance, and it's headed now down back to our support line. And that's a good thing. That means we can predict. It's working like it's supposed to.
That's right.
So if it continues tomorrow, we could be maybe into a trade by the end of the week.
Absolutely.
Okay. If it still continues on this trend, certainly by the time next episode rolls around, we can actually make my first purchase on the stock. So to recap how I'm going to do that is you will actually watch us pre-sort our list. We'll have a short list of stocks and options that we're looking at. We're going to buy one stock. We're going to buy one option. And I'm going to do that live on the show. I'm going to sort through my short list. We're going to nail it down to one or two. We're going to pick one. We're going to buy it. I'm going to go all through the whole process of buying it. You're going to see that, and I'm going to report exactly what I went into, how much it cost me. If I spent $500, $700, $750, you're going to know that, because I'm going to tell you that. And that's what we will hopefully do next week. Now, if the market decides to go haywire on us again and we have to continue to hold our cash and wait and be patient, then next week we're going to talk about how to properly set up this whole trading idea as a business. Okay, and that's going to be very important information. So if it's not next week, it'll be the week after. And even if you decide that you don't want to do stocks, this is really valuable information no matter what business you want to go into, because it will protect your assets, it will lower your tax bracket, you will avoid things like capital gains, you will set yourself up and your family up so that you avoid death taxes later. There's all kinds of, it's a wealth of information, and it will be free. This man, out of the goodness of his heart, he paid $3,000 to get the proper paperwork drawn up. He's going to give it to you for free. You won't have to pay a dime. And we're going to tell you how to set it all up, and why it works the way that it does. It was a very kind move on your part. So
Happy to be able to do it.
in fact, I had a guy call me today and says, I'm thinking about doing this as a business. He didn't read into that part on the resources tab yet. He says, I'm thinking about doing this as a business. He says, I really want to wait until I have the necessary funds to pay a business attorney to draw up my documents. I said, how much is he charging? He says, $3,000. I said, what if I can give that same paperwork to you for free? And he's like, what are you talking about? I said, it's already on the website. You can actually download the paperwork right now. So we're going to cover all of that next week, or we're going to buy our first option next week. If we don't cover it next week, it'll be the following week.
That's right.
So normally after that, as I purchase these things on the show, it'll be really short and quick, and we'll just do it and get it done, and we'll report, and we'll talk about other stuff. But for the first trade, I want to walk through it, micromanage it all the way through, and show people exactly what I'm doing.
Sounds good.
All right? Do you have anything else?
I think we've covered it all.
Be blessed. Peace out. Bye.
See you again.